Right now, today, the Crypto Fear and Greed Index reads 25 extreme fear, and it actually fell from 29 yesterday. Here's what makes that specific reading strange enough to build an entire video around. Bitcoin turned positive the same day. Trading volume rose to $68.99 billion. And futures open interest has been climbing for a week straight. Sentiment is getting more fearful while the market itself is doing something that doesn't match that fear at all. This isn't a coincidence, and it isn't unique to this specific week. There's a documented historical pattern behind exactly this kind of divergence, and it's the reason a specific group of Bitcoin holders treat a reading like today's as one of the more useful signals available, not as a reason to panic. This video is going to walk through the actual data behind that pattern, the specific psychological principles that explain why it exists in the first place, and why most people, despite knowing this pattern exists, still can't bring themselves to act on it when the moment actually arrives. Let's start with what the Fear and Greed Index actually measures, since the term gets thrown around constantly without much precision. It's a composite score built from 6 weighted inputs: volatility relative to recent averages, momentum and trading volume, social media sentiment, Bitcoin's dominance over other cryptocurrencies, Google search trends, and, historically, survey data. The index runs from 0 to 100, with readings near 0 representing extreme fear and readings near 100 representing extreme greed. The design assumption behind the index is worth stating plainly because it's the entire foundation this video builds on. Crypto market behavior is unusually emotional, and the index exists specifically to separate what an asset is actually worth from how people currently feel about it. The people who built this tool made 2 explicit assumptions. Extreme fear can mean investors are excessively worried, which can represent a buying opportunity, and extreme greed can mean the market is due for a correction. This video is not going to tell you that a low fear and greed reading is a guaranteed buy signal, and anyone telling you that is oversimplifying a genuinely useful tool into something reckless. What it's going to do is walk through the actual historical data behind this specific pattern, the psychological and economic principles that explain why it keeps recurring, and exactly why today's specific divergence, fear rising while price and volume both improve, deserves more attention than a single headline number usually gets. Before we get into the actual data behind this pattern, I want to point you towards something, because everything covered in the rest of this video, the historical readings, the mechanism behind them, today's specific setup, all of it becomes far more useful with a repeatable system sitting behind it instead of a single video you watch once and forget. That system is what the Bitcoin Holders Bible was built to be. It's not a theory book about market psychology in the abstract. It's a practical, step-by-step guide that walks through exactly how to read the Fear and Greed Index alongside the Onchain metrics this channel tracks every week: long-term holder supply, whale accumulation, and the handful of other signals that matter, translated into a 5-minute weekly check so you're reading the same signals seasoned holders check on a schedule, rather than reacting to a single headline number the one time a year it makes the news. The regular price of the Bitcoin Holders Bible is $97. I'm not going to give you the discount code yet, though. Stay with me through the rest of this video, because by the time we get to the end, you'll have seen the full historical case for exactly why a tool like this matters. And there's a specific $50 off code waiting for you when we get there, one that brings the price down to $47. For now, the link is in the description if you want to look at it while we keep going. Let's get into the actual data. Start with the most extreme version of this pattern, because it's the cleanest data point available. Since the index launched in 2018, it has fallen below 10 fewer than 10 separate times. Every single one of those sub-10 readings was followed by a positive return over the subsequent 90 days, with an average return of 48% and a median return of 48.5%. 0 instances produced a negative 90-day return. It's worth being precise about the honest limitation in that specific statistic before going any further, because presenting it without context would be dishonest. Fewer than 10 occurrences is a genuinely small sample size by any serious statistical standard, and that average return is itself skewed upward by one exceptional case: the recovery following the pandemic crash, which returned roughly 85%, and pulled down by a weaker case following the Terra Luna collapse, which returned only about 2%. A small, skewed sample doesn't mean the pattern is meaningless. It means the pattern deserves to be described honestly rather than oversold. The pattern holds up at a less extreme threshold too, with a larger, more statistically meaningful sample size behind it. Sustained extreme fear, defined as readings below 15 held for 30 days or more, has preceded strong 6 to 12-month returns across every prior Bitcoin market cycle since the index began tracking. This year's April and May stretch produced a reading of 11, one of the most sustained extreme fear periods in the index's entire history, driven by genuine macro pressure, geopolitical conflict, elevated inflation, and a Federal Reserve unwilling to move. The clearest single historical example remains March of 2020. As the COVID-19 pandemic triggered a simultaneous crash across every major asset class on Earth, the fear and greed index bottomed at 8, tied for the most extreme reading in its history. Bitcoin had fallen more than 50% in under 48 hours. By the end of that same year, Bitcoin had doubled from that low, and within roughly 20 months, it had reached a new all-time high. The mirror image of this pattern is just as instructive, and it's worth including here because a genuinely honest video has to show both directions. In November of 2021, right as Bitcoin crossed $68,000 and set what was then a new all-time high, the fear and greed index hit 84, deep in extreme greed. Altcoins were rallying aggressively, retail attention was at a multi-year peak, and within weeks, the market began the decline that eventually became the 2022 bear market. That symmetry matters as much as the extreme fear data itself, because a genuinely useful contrarian signal has to work in both directions to be taken seriously. A tool that only ever flagged buying opportunities during fear without ever flagging caution during greed would be describing a coin flip that only ever landed on one side, which would be a sign of a flawed measurement rather than a real underlying pattern. The fact that both extremes have historically preceded reversals in the opposite direction is what gives the whole framework its credibility. None of these historical instances constitute a large enough sample to treat this pattern as a reliable mechanical trading signal, and the index's own creators have explicitly warned against the overly simplistic interpretation that a low reading always means a good time to buy. A single index blending 6 sentiment-based inputs is also vulnerable to real methodology changes over time, since components like the survey input have been discontinued in some versions of the index, meaning readings from different years aren't always perfectly comparable to one another. None of the data in the previous section is useful without understanding the actual mechanism producing it, and the foundational principle here comes from a much older, much more general area of finance than crypto. Sentiment is mean reverting. When a market is gripped by fear, prices tend to sit below their fair value, because rational calm sellers get overwhelmed and undercut by participants who are panicking rather than calculating. When a market is gripped by greed, prices tend to sit above fair value, because buyers are paying a premium driven by the fear of missing out rather than by any careful assessment of what the asset is actually worth. This is not a claim unique to Bitcoin, and it long predates this asset's existence. It's the same underlying principle behind the well-known investing idea popularized across generations of value investors, that the more useful moment to act is precisely when the crowd's emotional state has become most extreme in either direction, rather than when it feels most comfortable to follow along with everyone else. There's a specific mechanical reason extreme fear tends to overshoot an asset's actual value, rather than settling calmly at a fair price. Fear triggers forced mechanical selling that has nothing to do with anyone's assessment of the asset's worth. Leveraged long positions get liquidated as prices fall, which forces further selling, which liquidates more positions. A cascade effect that has nothing to do with fundamentals and everything to do with margin mechanics. That cascade is precisely what pushes a sentiment index to its most extreme readings, since the index is measuring volatility and momentum, and a liquidation cascade produces both in abundance. This connects directly to two specific psychological mechanisms covered in earlier videos on this channel. Loss aversion, the tendency to feel a loss roughly twice as intensely as an equivalent gain, and herding, the tendency to mirror the crowd's behavior rather than run an independent analysis. Both biases intensify during exactly the kind of cascading mechanical sell-off that produces an extreme fear reading, which is precisely why the emotional experience of that moment feels like the worst possible time to buy, even when the underlying data suggests otherwise. This is the actual mechanical explanation behind why a contrarian approach isn't simply a clever slogan. It's a direct response to a well-documented tendency for fear to overshoot an asset's real value during a mechanical, forced selling event, then gradually revert back toward it once the forced selling exhausts itself, and calmer, more calculating buyers step back in. It helps to picture the actual sequence of participants involved in a typical fear-driven overshoot, because it isn't one single group making one single mistake. First, leveraged traders get liquidated, forcing mechanical selling regardless of their own view on Bitcoin's long-term value. Second, that forced selling drags the price down further and faster than any change in the asset's underlying fundamentals would justify, triggering the volatility and momentum readings that push the fear and greed index toward its most extreme levels. Third, unleveraged holders, watching that speed and severity of decline, begin second-guessing their own thesis purely because of how fast and how far the price has moved, even though nothing about Bitcoin's actual supply, adoption, or technology changed during that same window. Only after all three of those waves have largely run their course does the market typically stabilize and begin reverting back toward a price level more consistent with underlying fundamentals. Mean reversion describes a tendency, not a guarantee, and it says nothing about the specific timeline over which reversion actually happens. A market can remain irrationally fearful or irrationally greedy for considerably longer than any individual holder's own patience or capital can withstand, and treating mean reversion as a precise short-term timing tool rather than a general medium to long-term tendency is exactly the kind of oversimplification that turns a genuinely useful principle into a reckless one. Quick pause here because everything in the next few sections builds directly on what you just heard, and it's worth reminding you why I keep pointing back to the same resource. The mean reversion mechanism we just covered, forced selling, overshoot, gradual correction, is exactly the kind of pattern that's easy to understand watching a video and much harder to actually use in the moment your own money is on the line. That gap is the entire reason the Bitcoin Holder's Bible exists. It takes the fear and greed history covered in Section 1, the mean reversion mechanism covered in Section 2, and the on-chain data we're about to connect it to, and turns all three into a single weekly check you can actually run yourself, instead of trying to remember all of it the next time a headline about extreme fear shows up in your feed. I still haven't given you the code. I'm holding it for the end of this video on purpose, because I want you to see the rest of the case first, specifically the part covering why most people who already believe this principle still can't act on it. That part matters more than the discount does. Let's keep going. Here's exactly what happened today, and why it's worth more attention than a single sentiment score usually deserves. The fear and greed index dropped from 29 yesterday to 25 today, moving further into extreme fear territory, driven by rising investor caution, ongoing profit-taking, and lingering regulatory uncertainty. At the exact same time, Bitcoin turned positive on the day, and trading volume climbed to $68.099 billion. This specific combination, sentiment worsening while price and volume both improve, is the exact divergence this entire video has been building toward. If fear and price always moved in perfect lockstep, the index would carry no independent information at all. It would simply be a restatement of the price chart in different units. The fact that sentiment can fall while price rises is precisely what makes moments like today informative rather than redundant. There's a specific current catalyst worth naming that helps explain part of today's price action directly. Reports indicate the White House and Republican senators reached an agreement on ethics provisions restricting federal officials, including the president and members of Congress, from personally profiting through digital assets, removing a key obstacle blocking the Clarity Act's path through the Senate. That is the same legislative catalyst covered in the previous video on this channel, now showing continued tangible progress rather than fading. This is exactly the kind of setup the historical data from Section 1 describes, even if it doesn't yet qualify as an extreme sub-10 reading. Fear is elevated, a specific and identifiable positive catalyst is developing in the background, and the price action itself is already showing signs of improvement that sentiment hasn't caught up to yet. None of this guarantees anything about where price goes next, but it is a real, current textbook example of the exact divergence this entire video has walked through the history and mechanics of. It's worth naming why sentiment often lags price during exactly this kind of recovery, since the lag itself is informative. The fear and greed. Index's volatility and momentum components are calculated relative to recent trailing averages, meaning a single day of improving price action takes time to meaningfully shift a reading that's still reflecting the accumulated damage of the preceding weeks or months. This lag is not a flaw in the index. It's a structural feature of any measure built on trailing data, and understanding that lag is precisely what allows a holder to recognize a genuine divergence forming in real time, rather than waiting for the index itself to confirm what the price has already started to show. A single day's divergence between a sentiment index and price action is a far weaker signal than the multi-week, sustained extreme fear patterns covered earlier in this video. And today's reading of 25 sites meaningfully above both the sub-10 threshold with its strongest historical track record and the sustained sub-15 threshold that has preceded the strongest multi-month recoveries. It would be a mistake to treat one day's specific numbers as equivalent evidence to a 30-day sustained extreme reading. Today's data is suggestive and worth watching closely, not conclusive on its own. This entire pattern connects directly to on-chain behavior already covered on this channel, and the connection is worth making explicit, rather than leaving it as a coincidence. Long-term holder supply recently reached a record 16.75 million Bitcoin, roughly 84% of circulating supply, an all-time high reached precisely during the drawdown and elevated fear that preceded this week's rally. Whale tier wallets separately accumulated approximately 66,700 Bitcoin over the trailing 60 days, one of the strongest such waves of the year. Both of those data points describe the exact behavior this video's central principle predicts. The largest, most patient holders in the market accumulating specifically during the stretch when sentiment was at its most fearful, not waiting for sentiment to improve first before acting. That is not a coincidence layered on top of the fear and greed data. It's the same underlying principle, mean reversion in sentiment relative to fundamentals, showing up in two completely independent data sets that happen to describe the same underlying market behavior from two different angles. This is precisely why checking on-chain accumulation data alongside a sentiment index produces a more complete picture than checking either one alone. The fear and greed index tells you how the crowd currently feels. Long-term holder and whale accumulation data tells you what a specific, historically patient cohort is actually doing with real capital during that exact same emotional stretch. When both data sets point the same direction, fear rising while patient capital accumulates, that alignment is considerably more informative than either signal in isolation. It's worth noting explicitly that this alignment doesn't happen every single time sentiment turns fearful, which is itself part of why it's meaningful when it does occur. There have been stretches in Bitcoin's history where sentiment turned fearful without any corresponding increase in long-term holder or whale accumulation, and those stretches have generally proven to be weaker setups than the ones where both signals aligned. The presence of that alignment right now, both a fearful sentiment reading and active accumulation by the market's most patient participants, is what elevates this specific moment above a simple, generic, extreme fear reading. Whale accumulation and long-term holder supply both describe past and current behavior by specific, large market participants. Neither one is a guarantee that this specific pattern of patient accumulation during fear continues, or that it produces the same historical outcome this cycle that it has in prior ones. Large holders have been wrong before, and a cohort accumulating aggressively during a drawdown has, in less common instances throughout Bitcoin's history, continued accumulating through a considerably deeper and longer decline than the data at the time suggested was likely. Here's the uncomfortable part of this entire video, and it's worth sitting with directly rather than glossing over. Nearly everyone who has spent any real time around Bitcoin has heard some version of the principle covered in this video: buy when others are fearful at some point. Very few people actually do it when a real extreme fear reading shows up on their own screen with their own capital on a day exactly like today. The gap between knowing this principle intellectually and actually executing on it is not a knowledge problem. It's the exact same psychological mechanism covered in Section 2 working against you at precisely the moment you'd need to override it. Loss aversion doesn't turn off simply because you've watched a video explaining what loss aversion is. Herding doesn't stop pulling on your decisions just because you understand, abstractly, that the crowd is often wrong at emotional extremes. This is exactly why the historical data in this video matters more as a pre-commitment tool than as a real-time trading signal. A holder who decides, in a calm week with nothing on the line, that a specific fear and greed threshold combined with specific on-chain accumulation signals will trigger a predetermined action is making that decision before the emotional pressure of an actual extreme fear day exists to distort it. A holder trying to make that same decision live, in the moment, with the index reading 25 and their own portfolio underwater, is fighting the exact psychological mechanism this video just spent 2 sections explaining. This is the same principle covered in an earlier video on this channel about the 5 mindset mistakes that cost Bitcoin holders money, applied specifically to the buying side of the equation, rather than the selling side. A written plan, built in advance, converts a principle everyone already claims to believe into a specific, mechanical action that doesn't require summoning courage in the exact moment courage is hardest to find. There's a specific tell worth watching for in your own behavior that reveals whether this gap actually applies to you personally. Ask yourself honestly whether you've ever said, out loud or to yourself, some version of the sentence "I should have bought more during that specific drawdown," after the fact, once price had already recovered. If that sentence sounds familiar, it's strong evidence that you already believe this principle intellectually, and that the gap between belief and action is exactly where this video's framework is aimed. A pre-committed plan to buy during extreme fear is not automatically the correct decision for every holder's specific financial situation, and blindly deploying capital at every extreme fear reading, regardless of position size, existing exposure, or personal financial circumstances, is its own version of the same undisciplined behavior this video is arguing against, just pointed in the opposite direction. A real plan accounts for position sizing and personal risk tolerance. It doesn't simply replace one automatic, emotion-driven behavior with a different automatic behavior that ignores individual circumstances. Knowing that fear tends to overshoot value, and knowing that a written plan closes the gap between belief and action, still leaves one practical question unanswered. What does a real, usable process for this actually look like, in specific, checkable terms, rather than as a vague intention to be brave next time? The first component is a specific tiered threshold system rather than a single trigger point. Treating every reading below 30 as an identical signal ignores the meaningful difference between a reading of 25, today's level, and a reading of 8, the kind of extreme seen during the March 2020 crash. A tiered system might allocate a small, predetermined amount at a moderate extreme fear threshold, with larger, predetermined amounts reserved for the rarer, more extreme readings. This video's data shows carry the strongest historical track record. The second component is sizing each purchase against a fixed, predetermined percentage of available capital, decided in advance, rather than an amount that feels right in the moment. Deciding today, in a calm state, that a specific extreme fear reading triggers a purchase equal to a specific percentage of your cash. Reserve removes the exact moment of hesitation, where loss, aversion, and hurting have the most influence over the final decision. The third component is checking the signal alongside the Onchain data covered earlier in this video, rather than relying on the fear and greed index in isolation. A fear and greed reading of 25, combined with rising long-term holder supply and active whale accumulation, describes a meaningfully stronger setup than the same sentiment reading occurring while on-chain data shows distribution rather than accumulation. Cross-checking sentiment against actual capital flows is what separates a genuinely informed contrarian decision from simply buying because a single number looks low. None of this needs to be complicated to be effective. A one-page document written during a calm week listing specific fear and greed thresholds, specific position sizes tied to each threshold, and a short checklist of on-chain metrics to confirm before acting converts an abstract principle. Almost everyone already claims to believe into a mechanical process that doesn't depend on finding courage in the exact moment courage is hardest to access. A mechanical process built around historical thresholds is only as good as the assumption that this cycle behaves similarly to prior ones. And no threshold system eliminates the possibility of a specific extreme fear reading being followed by a deeper, more prolonged decline than the historical average would suggest. A written plan reduces the influence of in-the-moment emotion on a decision. It does not, and cannot, guarantee the decision itself turns out to be correct. This is exactly why the Bitcoin Holder's Bible exists, and it's the same resource I've pointed you toward twice already in this video, without giving you the actual number. Now that you've seen the full historical case, the mechanism behind it, today's specific setup, and honestly, why most people still won't act on any of this even after watching a video like this one, here's the code I promised at the beginning. It walks through the full history of the fear and greed index covered in this video. How to weight it against on-chain accumulation data like long-term holder supply and whale activity, and a framework for pre-committing your own specific thresholds and position sizes before the next extreme fear reading arrives, rather than trying to find the courage to act in the moment it actually shows up. The regular price is $97, and the code DIAMOND50 at checkout brings it down to $47. And just like I've told you before, that comes with a full money-back guarantee. If it doesn't leave you with a clearer pre-committed plan for exactly this kind of moment, you get every dollar back, no questions asked. Remember, this channel doesn't run on ad revenue anymore. Every person who picks this up isn't just buying a guide, they're one of the people actually keeping this channel able to keep making videos like this one. I see the diamond, and the link is in the description and pinned in the comments below. Again, the code is DIAMOND50, and it's live for a limited time. Every sub-10 fear and greed reading since the index launched in 2018 has been followed by a positive 90-day return, averaging 48%, though the sample size behind that statistic is genuinely small and skewed by one exceptional recovery. Sustained extreme fear, below 15 for 30 or more days, has preceded strong 6 to 12-month returns across every prior Bitcoin cycle, including the 11 reading recorded earlier this year and the 8 reading recorded during the March 2020 crash, after which Bitcoin doubled by year-end. The mechanism behind this pattern is mean reversion in sentiment. Forced mechanical selling during a liquidation cascade pushes fear to an extreme that overshoots the asset's actual value. And that overshoot gradually corrects once the mechanical selling exhausts itself. Today's specific reading of 25, falling even as price, volume, and open interest all improved, is a live, current example of exactly this kind of divergence, layered on top of a record long-term holder supply and one of the strongest whale accumulation waves of the year. None of this guarantees what happens next, and the entire reason most holders can't act on this principle, even when they know it isn't a lack of information. It's the same psychological mechanisms, loss aversion and hurting, working against the decision in exactly the moment it matters most. A written, pre-committed plan is the only tool this video knows of that reliably closes that specific gap. A tiered, pre-committed process, specific thresholds, specific position sizes, and a short checklist of on-chain metrics to confirm before acting is what actually turns this principle from something you agree with intellectually into something you can execute mechanically without needing to summon courage in the exact moment it's hardest to find. Nothing in this video should be read as a guarantee that today's specific fear and greed reading, or any future reading like it, produces the same outcome the historical data describes. The sample size behind the most extreme version of this pattern is small, market structure has changed substantially since Bitcoin's earlier cycles, and a market can remain fearful, or remain in a genuine decline, for considerably longer than any specific historical average would suggest. Buying during fear is not a strategy that guarantees a favorable outcome on any specific occasion. It's a documented tendency that has favored patient, disciplined buyers across most, though not all, of Bitcoin's prior history. Treating a documented tendency as a certainty is precisely the kind of overconfidence this entire channel exists to help holders avoid, in either direction. It's also worth being honest that this video's own framing could itself be criticized as survivorship bias, built from a history where Bitcoin has, so far, always eventually recovered from every prior drawdown. That history is real and verifiable, but it is not a law of nature, and every one of the historical examples covered in this video benefits from hindsight that wasn't available to the people actually living through the fear at the time. Approaching this principle with genuine humility about that limitation is part of what separates a disciplined framework from blind faith dressed up as data. Smart Bitcoin holders don't buy during extreme fear because fear feels good, and they don't do it out of blind contrarianism for its own sake. They do it because a documented, historically repeated pattern shows sentiment overshooting an asset's actual value during exactly this kind of mechanical, forced selling event, and because the largest, most patient holders in the market have already positioned themselves accordingly, verified through the exact on-chain data this channel tracks every week. The gap between knowing this principle and actually acting on it has nothing to do with intelligence, and everything to do with the same psychological mechanisms this video has walked through twice now. Closing that gap requires a plan built before the fear arrives, not courage summoned in the moment it does. Drop a comment below telling me what the fear and greed index reads for you right now, and whether you've ever actually acted on an extreme fear reading with real capital, or only ever considered it after the fact. The most thoughtful comments get pinned, because the goal of this channel has always been clarity, not telling anyone what to do with their own money. If this video changed how you think about today's specific reading, share it with the one holder you know who's currently more scared than the data actually supports. Every cycle produces the same split among holders at exactly this kind of moment. One group feels the fear, checks it against the actual historical data and the actual on-chain behavior of patient, large holders, and acts according to a plan built long before this specific day arrived. The other group feels the exact same fear and lets it make the decision instead, often citing the very same principle covered in this video as something they believe, right up until the moment it would have actually cost them something to act on it. Today's reading is 25. It might be higher or lower by the time you're watching this, and this video was never trying to tell you what to do with that specific number. It was trying to show you why the gap between what you believe and what you actually do at exactly this kind of moment is worth closing before the next one arrives. See you in the next one.